Hello, I'm Austin Wilson, Research Analyst at Hixon Zuercher Capital Management.
And I'm Josh Robb, Director of Wealth Management at Hixon Zuercher Capital Management. Today we're going to be looking back at March and talking about the events that happened there. And then also I'll be giving you some tips on ways to save money this year.
Absolutely. So, we always start with it, but the markets in March.
Yes.
The markets in March. Markets were mad. March madness.
That's it.
That's right. Well, everyone's bracket was ruined. Mine included.
Oh, it was not good.
Yours included.
Yep.
So anyway, the markets were mad. The brackets were mad. Markets actually were mad in a good way, though.
Okay.
They were
crazy
mad going up. So here we go. S&P 500. So large cap.
Yes.
U.S. stocks. Good blend of everything there. 3.5% return for the month. That's pretty good. Dow Jones Industrial Average, 1.89%. NASDAQ, 6.69%.
Wow. So the growth end
of things did well, and that actually was like the best quarter, ended the best quarter for the NASDAQ since 2020.
Okay.
Which it had a huge rebound then as well. Developed international stocks, I think more Europe and things like that, up 2.54%. Emerging markets, 2.73%. Bonds, 2.54%, right? And I saved the best for last, or the worst.
Okay.
Small cap stocks.
Yes.
More on that later.
Yes.
Down 4.98%.
I'm assuming one sector contributed a lot to that.
You're ruining.
I'm not going to say which one.
Okay.
Just one sector.
One sector. Yeah, we're going to say that.
All right. So I'm going to start off by talking through some 5 different tips to help maybe save some money this year. So the first one is very important. It's create a budget and stick to it, right?
That's a good one.
Until you know where your money's going, it's hard to know the best ways to save or reduce those costs. And so having a budget, planning out where your expenses are, how much goes to each category is good. I like to use as kind of the default is a 50-30-20 budget, 50% towards your needs, 30% towards your wants, and 20% towards savings. Savings or paying off debt. That's kind of that bucket for that.
Yep.
So first way to save money is first understand where your money's going.
Create a budget.
Yep.
My second thing explains the end of my first thing.
Okay.
So the end of the first thing I said, small cap stocks were down almost 5%, and you burst my surprise by saying one sector contributed to that, and that's true. That one sector was
financials.
So the small cap environment has a lot more weight to the financial sector than large cap stocks in terms of the overall market. So what happened to financial stocks? Well, you might have heard there were some issues in the financial system. Numerous banks, a couple, went actually under, and including Silicon Valley Bank's kind of the one that everyone's been talking about. So really, we need to just briefly explain how this happened. So we've had really low interest rates for a long, long time, right? Really coming out of the global financial crisis, they never got high. So we had low interest rates. Banks, how do banks make money? Well, banks make money really on a lot of times on the spread between what they're paying in interest versus what they're earning in interest. And to earn, you got to invest. So they're taking client deposits and they're investing them in bonds. Typically treasury bonds, very safe. Typically pretty short-term treasury bonds, which are really
safe from default.
Yes. But what happened in the last year, if we recall, is that interest rates shot up. Really across the board. A lot of it was on the short end as well. But interest rates shot up. And what happened with that is because interest rates shot up, bond values went down. So all these banks, all banks really, who held bonds, they're planning on holding them to maturity, and then they're not going to have any issues. But in the middle of all of this, they have losses. The bonds are down in value. So what happens specifically with Silicon Valley Bank is, well, they were a bank for tech companies, tech executives, which were already in a tight spot on cash and pulling cash out anyway. Well, they also then continued to need more cash. Well, the bank needed to get them their cash by selling their bonds at a loss, and they kept doing that until they ran out of money. It was a very bad thing. So the question you might ask, Josh, is...
I have a question.
Please.
Are people's money at risk at these banks?
Generally, no.
Okay.
So here's what happens. You have really 2 kinds of insurance, right? When it comes to your deposits. Number one, FDIC insurance for typical banks is going to be up to $250,000. Your deposits are safe and backed by the government. And FDIC insurance is really insurance that the banks are buying from the government, and they pay for FDIC insurance over time. And then when it gets needed eventually, the government has the money to pay out.
Yep.
So that's how that works. So FDIC insurance through your bank up to $250,000
Per person, per account
per
type.
person per account or account type. So that's why if you have more than that, a lot of times you split it between multiple institutions to spread that out. So that's one type. Another type is you might say, well, maybe my money is in a money market fund at a custodian like Fidelity, Schwab, and one of these major custodians. Is my money safe? And the answer would be similar.
Yes.
Generally, yes. SIPC insurance, SIPC insurance is what that is. Very similar in the way that is not always a fixed amount.
Yep.
It starts at $250 and can actually go up depending on your custodian.
They can have more insurance.
They can have more insurance. But generally speaking, if you have less than $250,000 of cash at a major financial institution, you're not going to have any issues.
Some peace of mind there.
That's some peace of mind. So that kind of explains what happened on there. Overall, you might also ask, are we in a financial crisis?
Are we in a financial crisis?
Good question.
Yeah.
I would say probably not.
Okay.
It seems that Silicon Valley Bank specifically was an example of some over-aggressive, even though they're buying government bonds, they were buying them a little bit longer duration to try to earn more interest. Well, they got a little aggressive, and most banks weren't doing that. So therefore, that was kind of a one-off situation. There is going to be some squeezes. Some banks are going to have a little bit tougher time for a while, but they should be relatively safe. So we're not in a financial crisis. Coming out of 08, 09, the global financial crisis, our banking system got a lot more stringent on requirements for capitalization ratios and stuff like that. So banks actually get tested, stress tested frequently to make sure that they can sustain sort of these issues over time. So especially the larger banks are in a fantastic shape right now. So yeah, I would not be too concerned.
Okay. So you have a budget. Next step. Now that you know where your money's going, to review all of your expenses. There may be reoccurring expenses that you no longer need. That's a big thing now, especially with automating some apps and things like that. They're going to charge you annually or monthly for something that you may not be using anymore.
Yeah.
So review all your expenses. What are the things that you could adjust or eliminate altogether is a great way of saving money.
Yeah.
So there are apps out there that do that for you. They'll look at all your recurring expenses and give you suggestions.
Yep.
But then also look at the things that you have control over. Eating out, those type of things. Entertainment. Do you want to save some money? Those are some spots you could cut in.
Absolutely.
Yep.
My third thing is inflation. Inflation, again, we're going to talk about it, but it cooled a little bit more, but largely as expected in the month of February, which is the latest month we have. Headline Consumer Price Index came in at 6% year over year, which was actually down from 6.4% year over year the month before. PCE, Personal Consumption and Expenditures, which is the Federal Reserve's preferred inflation gauge, different basket calculation, followed suit with cooling off even more and was actually better than expected and was actually down 0.1% month over month and only up 4.6% year over year. So inflation, while still elevated by historical standards, is moving in the right direction.
Perfect. All right. So we're going to stick with the spending side of things for one more tip. Impulse purchases, right? It's easy to shop on your phone when you're scrolling or on Amazon, those type of things.
Guilty.
Or you're at the store and you walk by and you see something. One of the best ways to save money is to slow down your purchasing process. So to say, all right, I'm going to wait 24 hours and still decide, do I actually need that?
Right.
And so if you can delay gratification, that's a great way of building the habit of saving money.
Or here's another one.
Yes.
You could delete the Amazon app from your phone.
Just get rid of the temptation.
And then you have to sit down at your computer. You can still use Amazon, but you have to force yourself to sit down at your computer to use it. Because it's just so easy.
Yes.
I did it this morning. I was like, I need an extension cord. Boop, boop. It'll be here tomorrow. But it's so easy. It's too easy to do that. You're going to spend more money over the course of a month. So that's another pro tip there. Number 4, the Fed.
Yes.
We are going to continue to talk about inflation in the Fed until we're blue in the face.
Yep.
Or until inflation comes down, the Fed is not doing anything too extreme. But in continued response to an inflationary environment, they gave us another 0.25% interest rate increase on March 22nd. So as of now, it's actually a coin toss whether or not the Fed will hike another time here coming up. But inflation is coming down. The banking system has seen a bit of stress, so they may think about taking a pause. It's kind of a coin toss right now, but that's kind of where we are. We're nearer to the end of the hiking cycle than the beginning, and that is a good thing, and that's one of the reasons the markets have done so well.
Great. All right, so we're going to flip to the other side If you're looking for ways of saving money, cutting your expenses is one,
Yep.
but increasing your income is another way.
That's a good one.
So look for ways to earn extra income, whether it's additional overtime at your job, whether it is part-time work, or doing, like we call it, the gig economy. We're finding some additional income. That's another way. If you don't want to cut spending, that's another way to increase your saving.
Absolutely. Awesome. And fifth and final thing from me, job openings.
Yeah.
Job openings just came in cooling more than expected for the month of March. So we just got March data, and under 10 million jobs available in the United States for the first time since 2020. That's definitely a step in the right direction, as one gauge of employment health in the U.S., or the labor market in general, is going to be a ratio between job openings and people unemployed. And that was pushing almost 2 times the amount of job openings for the people unemployed, which has kept upward pressure on things like wages and stuff like that. So that coming down is actually helping the inflation story over time. So the Federal Reserve, one of their other mandates, they have inflation as one mandate, stable price environment, but also full employment. They still have the full employment thing, but if they can squeeze that gap a little bit more, they're going to be even more apt to kind of be like, okay, well, things are cooling off enough. We can take our foot off the brakes on these interest rate increases.
Yep. And that's because it sounds weird to say that fewer job openings is a good thing.
Right.
But what you're actually looking at is saying, you know what, there's still job openings.
Yeah.
But the problem was there were so many job openings, the increase in wages and what you had to offer was putting inflation pressure. So it makes a lot of sense. All right, my final one is we're doing one last look at ways to save money, which is take advantage of programs that are offering either cashback rewards, if we're talking credit cards, or when it comes to saving money, employee matches for your retirement account.
Absolutely.
So make sure you're taking advantage of any programs that are available to enhance your saving opportunities. And so there's a lot of software out there that, if you use a certain card, they can round up and save some money. There's all different ways. But if it helps for you to increase your savings that way, there's a lot of fun programs out there to make it easier to do it.
Absolutely. Well, thank you, Josh, for those money-saving tips. And as we mentioned earlier, I'm Austin Wilson, and this is Josh Robb with Hixon Zuercher Capital Management. We hope you enjoyed our update. As always, nothing we talked about today is a recommendation, but if you have any questions about your financial situation, feel free to give us a call, 419-425-2400, or email us at hello@hzcapital.com. And until next month, have a good one.
Talk to you later. Bye.
Josh Robb and Austin Wilson work for Hixon Zuercher Capital Management. All opinions expressed by Josh, Austin, or any guests are solely their own opinions and do not reflect the opinions of Hixon Zuercher Capital Management. This is for informational purposes only and should not be relied upon for investment decisions. Clients of Hixon Zuercher Capital Management may maintain positions in the securities discussed. There is no guarantee that the statements, opinions, or forecasts provided herein will prove to be correct. Past performance may not be indicative of future results. Indices are not available for direct investment. Any investor who attempts to mimic the performance of an index would incur fees and expenses which would reduce returns. Securities investing involves risk, including the potential for loss of principal. There is no assurance that any investment plan or strategy will be successful.